In this video, we're going to talk about tail insurance and specifically how it works when you're selling your company. I'll also take a few minutes to address what to do if buyers are demanding a 5 or 6 year tail and your policy can only offer up a 3-year tail. Coming right up. Hi, I'm Gordon Coyle. Welcome to my channel where we talk about the risk and insurance issues on the minds of business owners. If I don't answer the question on your mind that brought you to this video, reach out and let's connect. I'd love to hear from you. So let's start with what a tail is. The actual name for a tail is an extended reporting period, or ERP, and it's commonly part of a claims-made policy form like D&O, E&O, or professional liability, cyber, employment practice liability, environmental insurance, and so forth. A tail, or ERP, is needed when you cancel a claims-made policy so that the policy provides protection for situations or acts that took place prior to the cancellation date that could give rise to a claim which is reported after the cancellation date. Now, I know that seems confusing. Why do you need protection after you cancel a policy for potential claims that took place prior to the cancellation date? Wouldn't they automatically be covered? Unfortunately, no. A key concept in a claims-made policy is that the policy or a policy must be in effect at the time when the claim is reported, not when it took place. This is how the category of policies got their name. Claims made means the policy will respond when the policy is in effect when the claim is made or presented to the insurance company. So, why is it important when selling your company? Well, for 2 reasons. First, you want to be sure that if a claim is made or comes up a year or 2 or more down the road, that you're protected. Here's an example. You sell your company today and 4 or 5 months down the road, that problem employee decides that they're going to sue you personally for harassment while they worked for you. You had employment practice liability or EPLI, and you may say, I never harassed any employee. And while that may be true, it doesn't stop someone from suing you. At the very least, you'll need to defend yourself, and that can be expensive. Purchasing a tail at the time you canceled that policy will protect you from this situation. Without the tail, you're on your own. The second reason is that buyers will want to be sure you're protected from claims for prior acts so they're not footing the bill for defense and potential settlements. So what happens when a buyer demands a tail that's longer than the policy actually can provide? Now, a problem that often comes up is that the buyer demands a 5 or 6 year tail and your policy can only do 3 years. You plead with your broker that without the longer tail, your deal is dead, but to no avail. And they say 3 years is the best we can do. Now what? Well, this is where you call me. We've resolved this situation many times over the past few years, and it requires some out-of-the-box thinking. Well, you may say, can't I just keep renewing the policy after the transaction date? Unfortunately, no. An unusual feature in most claims-made policy is something called a change in control provision, which says that when 50% or more of the company's stock is sold, merged, or acquired, the policy automatically terminates upon the signing of that transaction. So you're out of luck there. What does a tail cost? The cost of a tail is typically based on the duration and is going to be defined in the policy declarations. Often, a 1-year tail is going to cost 100 to 125% of the current policy's premium. A 3-year tail is generally 200 to 250% of the current policy's premium, and a 5 or 6 year duration is going to be 300% or greater of that policy's premium. If there are claims in your history of that particular policy, pricing may be higher than these estimates. Now you may ask, who pays the costs? We've seen situations where the buyer will assume the cost, but often it's borne by the seller. If you are the seller, it never hurts to ask the buyer to contribute to the cost, but keep in mind, the tail or ERP ultimately does benefit you and it's there for your protection. You may be asking, why don't occurrence policies like general liability need a tail? Good question. Occurrence policies respond to claims based on when they occurred, not when the claim is reported. Claims reported after the cancellation of a liability policy for situations that occurred prior to the cancellation are covered. Now, an exception to this rule is that a problem does happen, needs to be addressed, and that's completed operation claims, typically for contractors, and products liability claims for manufacturers and distributors, and we'll talk more about that in a separate video. To wrap it up, there's often a lot of confusion with regard to claims-made policies in mergers and acquisitions. Brokers that are not familiar with these policy forms aren't sure how to handle them or what to do when a curveball comes their way. That's where the role of a skilled broker like the Coyle Group can step in and provide solutions and practical advice. If you'd like to learn more, please contact me. My contact info is in the description box below, and we'd love to hear from you. Thanks for watching, and if this content was helpful, do me a favor and hit that like button. Thanks.